G'day listeners and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, we have got a very special episode. We have got some big guests, some big heavy hitters on the table. We've got two big heavy hitters, and we've got something that the cat drags in. I don't know what you call this thing, but we've got a third one on the end of the table. But guys, very, very excited to be running through today's app. There is a lot of stats to unpack today in essentially an end of financial year recap. Now, there has been a huge amount that's gone on over the past 12 months. A lot of big, policy changes, a lot of big interest rate movements, inflation, all the rest of the sort of stuff. A lot of things have been going on. So I've got my big property economist, big Lukey Teeuwsen, mate. Welcome to the show. Welcome back.
Thanks for having me. I've got a bit of an upgrade since I was here last. So
New studio. Mate, how good? How good?
I think it was on the back of your episode. Numbers went through the roof. So
we got more budget and now we got a studio. I don't know. Coincidence? I think not.
Lukey, mate, welcome back. Miss Morgan Holmes as well, another senior buyers agent at Australian Property Scout. Welcome back to yourself as well.
Thank you.
Now, a lot of people might know Morgan from the 26-year-old investor that created over $1 million net equity in around about a 2-year window. So, Morg's great to have you back on the show.
Thank you.
And wasn't that episode one of the highest rating episodes?
Who are you?
Just cousin It on the
cousin
side.
It, mate. That's being generous. Big Jimmy, welcome back, mate. Welcome.
It's good to be here, and it's great to have our guests here in the studio. People have asked for some better looks and some more intelligence. Yes. So we thought we'd bring the two.
And some big stature. It's funny if you guys are watching on YouTube or on the clips, these guys look about the same height. There's literally a foot difference. Lukey is 6'7" and Morgs is 5'7". So it's very good camera visuals by the team behind the scenes. But Jimmy, you were about to say before, mate, in regards to Morgs, she is one of the highest rated EPs. She may even be the highest. We're doing a stat unpack today, even on the Scouting Australia podcast. So well done. That's very, very impressive. But today, Jimmy, mate, I'm looking forward to unpacking this. There's so much. The last 12 months has been wild. It feels like the last 3 or 4 years has been wild. There's been, we had COVID, we had election things happening. There's been, markets went crazy. Markets have flattened off or crashed. Had crazy inflation, build prices, interest rates, everything. Mate, there is a lot to go through.
You're right. And I think it's great to have this kind of episode because last episode we were talking about, planning for your tax planning for the end of financial year. And just to give us a bit of a wrap for all of our listeners out there, because you forget what happened 12 months ago. And when we started with Lukey, we were talking about a couple of the numbers, which you're going to go through. It was actually like this last 12 months has been unprecedented in so many different facets. So hold on to your hat, folks. There's going to be a lot of stats. There's going to be a lot of intel. And the whole plan of today is to get you better prepared for next financial year. Let's face it,
Definitely.
Right?
It's always about taking a good look in the rear vision to be able to plan properly for the way forward as well. So I'm looking forward to it.
So what I thought, Sammy, was a good place to start really is to just give us a bit of a macro view because when we're looking about a year in review, Lukey, and you're the stats man, right? So the numbers, but there's a whole bunch of different facets that we wanted to really go through. We're going to want to talk about interest rates, the difference between, last July to now, inflation, stock levels.
Yes, we'll touch on that, yes.
Population growth. So we're going to unpack as much information as possible. And I thought, what a good place to start, shall we? Do you want to start with interest rates? Because interest rates...
It's the talk of the town, mate.
It's the talk of the
town. Talk of the country. It's the talk of the country for the last 12, 18 months. However, it's been 15 months or so. It's been going nuts. So I think it's very good to, obviously dive into and unpack that a little bit as well. So, Lukey, mate, we will hand the proverbial mic over to you because you have your own one. Give us your insights, mate. Let's jump into it.
Yeah, well, massive year, actually. Well, we started the financial year. There'd been 2 increases last financial year. So everyone was like, oh, well, is it going to keep going? First one, 6 days into the new financial year. So 6th of July, we had the first one. But it started financial year 0.85%.
Yes. Was the cash rate.
Cash rate.
0.85%.
The interesting note on that, though, obviously, was we were coming from record lows of 0.1. And at this point, we had already had a 0.5% increase and a 0.25% increase. So we're up to 0.85%. And obviously, it started a very steep uphill climb.
Yeah, tend to come after that.
That was the third one, right? Yep. So even at that point, people were going, oh my God, it's ludicrous. There's been 3 rate rises.
2. It was only 2, but it was 75 basis points. It was big.
Yes,
especially at the time because it was really controversial because the RBA had come out and said, we will not increase rates till 2024. And a lot of people people had gone, yep, perfect, let's jump in.
Budgeted for that, right?
Budgeted for that.
Yeah.
And then they started increasing and they go, well, they didn't tell us this was going to happen. Start of the financial year, started 0.85%. 6 days in, we got a 0.5% increase. And then there was another 9 after that. So 10 for the full financial year if we're doing the financial year recap. So ended at 4.1%. So 0.85% when we started.
10 out of 12 months.
That
is insane.
And you know what the crazy thing? It's actually 10 out of 11 because they don't do one in January. So it's actually 10 out of 11 increases. And then they smashed it after they paused for one. And then the one they paused on, which I think was Feb or March. And then they just went nuts. It just like the market went crazy. So then they had to punch it in again and kind of push it pretty hard. So, the way I like to look at this and think about as well, like the crazy part of this is obviously, I know we're talking about the financial year in review, but just the amount of increases we've had during that period, like even call it the 15 months from when it first kicked off, we're up 4% in terms of an interest rate increase. That's just wild, to see it get back to those levels. And obviously the 0.1 to 4.1, that doesn't translate into what you're actually getting from the banks because it's obviously passed on. They have to make their margin on it as well. So a lot of the, most people now are kind of paying around about that 6% interest rate, slightly under, slightly less, depending on LVRs.
Can you, for all of our listeners out there, especially the beginners out there, when they're looking at the cash rate, because interest rates, and if you're not familiar with this, it is a bit confusing, don't you think, guys? So when you hear the cash rate and you're like, okay, so 4.1% is where it's ended at the end of the financial year, but my interest rate is 6 or 7 or whatever it is. Can you explain to people out there what's that variance? How is it?
Did I literally just say that? It's what the banks
I want you to break it. Yeah, but why do they charge it?
Because they're banks. No, that's not a buffer. It's a profit margin. It's what they're in there to do. You got to remember.
No, but what about APRA's extra allowance?
No. Okay, so APRA's extra allowance is a buffer rate. So it's got absolutely nothing to do with what the interest rate is at and what they're charging you. So what they're charging you, that difference is obviously the operational costs of running a huge business. These businesses are the biggest businesces in Australia. Yeah.
Employees, marketing.
Exactly. Everything. So, branches, all that sort of thing. Everything involved with the day-to-day of it, realistically, it's probably, it's probably a lot less. But I was going to say, let's call it 1%. And then the other 1% is their profit margin. Realistically, the size of the banks and how much they make, it's probably 0.1% and the 1.9 is their profit. But that's the gap, right? So the 4.1 is what they're borrowing the money at, and what you're paying for it is essentially the difference and the fat plus the costs and the expenses and everything of what they make in between. It's their gross profit minus obviously their costs are going to be in there as well.
Yeah, and what you mentioned about APRA put a servicing buffer on top of that to make sure people can afford their loans if rates continue to increase. At the moment, that's 3%. So if rates are at 7, you're being assessed at 10%.
And the reason why they increased that as well was because the cash rate got so low that RBA cash rate got to the 0.1%. And so at the time, their buffer rate, the serviceability buffer rate was actually only at 2%. But that means if you were borrowing, there's a lot of people out there borrowing money, getting primary residence loans at 1.99, right? If they're only doing a 2%, that's only getting assessed at 3.99, call it 4%. So essentially they added the extra percent on. So instead they were getting assessed at 5% because they knew something like this was coming. This rapid increase was going to have to happen. They dropped the cash rate to help stimulate the economy and keep us afloat during COVID, and they did well. But now things went a little bit crazy from an inflation perspective. And this is essentially their way to curb it. So they increased it so that people didn't get caught out. So when they started borrowing money just before it happened, it wasn't a 2% variance, because you got to remember, now we're double that. They've done 4%. If you only got assessed at 2, there would be blood, absolute blood on the street. So it's it was a safeguarded way of doing it. But I think the interesting thing and what's coming as well is the fact that they're more than likely going to cut that now. Now that we're very close to the peak of the current interest rate cycle, there's been a lot of chatter for quite a while now about them cutting that cash rate back. And when they do, essentially that scenario Lukey was giving you before about, you're borrowing your money at 7, they're assessing you at 10, that now they're going to cut that 3 down to 2. So instead they're going to assess you at 9. That in turn is actually going to increase a lot of people's borrowing capacity. So they got to be wary when they do that too, because that's going to throw a lot of investors that previously couldn't get back in. That's going to throw a bit of fuel back in there.
Some banks have actually started doing it already. So
a lot of your non-bank lenders, right? Don't fall under the same policy.
Non-APRA regulated banks have dropped it as well. So it's going to be interesting to see what other banks do to compete with that.
So in the market, you're going to see a lot of people, as you said, Sammy, that couldn't borrow money because of that extra buffer, and now they are, and they're going to come into the market, which is obviously going to have a flow-on effect on supply and demand and pricing. So is it fair to say prices will remain buoyant?
As people start to service more and the servicing capacity comes back in, absolutely. What the properties at the moment are the same properties as they were 12 months, 24 months ago, there's just less people that can afford to service it. So you look at a 10% assessment rate on $1 million loan, that's $100,000 interest. And obviously as you go up, it gets more expensive, but there's just less people that can afford to service it. So when you go to an auction, there's not 50, 60, 100 people competing against each other. There's your sort of top of your market that are able to service at that percentage. There will always be able to people that can service at $2 million, $5 million, $10 million loans. There's just less of them.
I think there's two things to take into account here as well, right? Or to take on board from you talking about that is one is the stock levels, like because that when you combine the two, there's less people out there, right? But because stock levels are so far down, that's actually helping keeping a floor under the market. Because yes, all right, instead of 60, there's 6, right? But instead of there being 30 properties coming to market that month, there might only be 10. So while that imbalance is still there from that different ratio, it's not as great as it would have been if there was plenty of stock around.
Yes.
When that comes in, that's what can really essentially cripple a market. But until that really comes to the fore, which we're not going to go crazy into stock levels today because we're going to be running a full poddy on that next week because people are asking us all the time, why are stock levels so tight? So we're going to run specifically on that next week. But I think it's important to touch on that is essentially people are asking if interest rates have gone so high. And this is coming, this cliff's coming, essentially like what's keeping the market from crashing? Why hasn't the market crashed? And stock levels are quite literally the big indicator as to why they haven't.
But is it fair to say at that high end where people have leveraged a lot of money, you're going to see that more blood on the streets?
Yeah.
But in the price point of investment grade markets that APS focus on?
I'll give you an interesting stat that I remember. I actually read this morning, right? A very, very interesting stat. It's 23% down year on year from this time last year to where we are right now on $1 million markets in the country. 23% down from markets that went to $1 million plus. And I know you and I have spoken about this multiple times, actually with all of you guys, but essentially around the fact that a lot of markets in Sydney had their boom in 2013 to 17, and then I never thought they were due for another run, right? But the COVID pushed them into that next run. And people thought that was a new norm, that it went there. But what always happens is when a market gets artificially inflated, when that heat goes and that demand that comes from it goes, they drop back down, right? So like once that heat goes, essentially it pulls back. And so it's very interesting to note, and I remember I was reading this and kind of going through all the data and the stats and everything on it as well. It's very interesting to note a lot of these like kind of more like the areas that were like COVID-driven boom sort of markets. They're the ones that have had a lot of contraction. Sydney as well. The bulk is literally 78 of I can't remember the exact number of suburbs that were down, but 78 suburbs in Sydney that 12 months ago were considered that were $1 million plus and now actually back under $1 million. That's a lot of markets to slide. So I think it's a very interesting thing. It's a lot of people ask me why I sell properties at different times. Remember when we spoke about the second deal I've ever sold? It was literally in one of those markets. I sold it a little over 12 months ago as that market was kind of peaking out because I knew once that heat went out of that market, it 100% was going to come back because it was an artificial heat that was in there.
But what about when Sydney the interest rates paused for a little bit, and then there was a lot of talk about Sydney, the market rebounding. What would you say in that scenario?
So Sydney it came back about, depending on the market you're in, anywhere between 10 to 20% last year. It came back in value, 10 to 20%, which is a big hit, right? So essentially it bottomed, right? It has bottomed to an extent, but I think the important thing to note is it's come back and it's bottomed, but I don't think the full hit and the full force of interest rates has hit it yet. So I think like over the next 6 to 12 months, it's going to be very interesting to watch that play out because more stock will come to the market. But if you have less people competing, especially at those higher end price points, where are those markets going to end up and stay? And so, man, I'm not bullish. Like I don't sell properties unless I have a good feeling to sell them in terms of like, I think a market's peaked out. There's a reason why I sold out of those assets. Obviously that market in itself came back 15% plus in my specific market that I sold out of. But I still think the outlook is a little bleak. It depends on stock. It will all depend on stock and how it comes back. How it comes back to the table in the next 6, 12, 24 months, in this current interest rate environment.
Great. Well done, Sammy. I think you've started pretty well.
We wrapped?
What do you think, guys?
Bit of gold.
He was a bit hot early, wasn't he? You throw a little bit of burley out there. So the plan.
Have you ever been hot, Jimmy? Has anyone ever called you hot?
So you get
like straight out of a freezer, that fucking cold, mate.
You get him started, and he gets a bit of. That's it. The tail starts going.
Lukey's got the notes, mate.
He's got a few more.
Lukey, let's go.
The next one was it inflation?
Yeah, so inflation. So end of June. So quarterly data. June 22, we ended the quarter at 6.1% for inflation. So quite high. The target range is 2 to 3%. If you haven't heard about that, there is an episode a few back about that. But
He's trying to give himself a bit of a plug. Is that a bit of a plug? He's trying to get some boost some numbers?
I'm trying to overtake Morgan. Morgan's
no chance. No chance.
Morgan's gone off, and I'm like, well, how do I get more people on the line? So.
Morgan's is like Usain Bolt versus the silver dog. You know what I mean? You're still in the gates, mate. She's fucking home. She's already got the gold medal and gone.
I'm not sure inflation is a real sexy topic.
No,
Lukey.
it's not. It really isn't. Anyway, 6.1% we started the financial year at. So
this is 12 months ago.
12 months ago.
Yeah.
So end of June quarter, 6.1%. So a lot over the target range of 2 to 3% for the RBA.
More than double.
Correct. So went up and peaked at the end of the December 2022 quarter. So 7.8% after that quarter.
That's big.
Didn't account for any Christmas spending as well. So which meant the March 2022 quarter, which is our latest quarterly data, was at 7%.
Yeah.
So didn't drop all too much. We're still far higher than they needed to be.
Yeah.
For the financial year, we don't obviously have the June quarter data yet at time of filming, but we're up 0.9% inflation for the financial year. So we started at 6.1 and we're ending at 7.
I think the important thing to note with that as well, the thing to look at is obviously they're pushing up interest rates to try and stop people spending, right? And really curb back spending to help curb inflation. Essentially, the government's trying to stall the economy, right? Which they need to do to stall inflation. But I think the interesting thing to note in that time frame that you're talking about, the numbers and like what they were trying to achieve, it's really hard to achieve it over Christmas, right? And the holiday period, because everyone's out. It's the one time a year everyone is out spending. So while they curbed it to an extent, from the September quarter to the December, and interest rates probably had a big impact and a big play in that. The ability for them to curb it further during that next window is almost impossible because it's that high spend. Like, who doesn't go out and spend in? I don't know if you got anyone to take out, Jimmy, but you're probably going out by yourself, spending, I'm going to buy myself 2 drinks because there's no one to drink
Some
with
baklava.
you. Baklava, you know what I mean? So there's still everyone out there spending money and spending big and holidays and all the rest of the sort of thing. And very, very hard for them to pull it back in. So it's going to be really interesting. I know we're a week out from essentially that end of financial year at time of filming, but it's going to be very interesting to watch how that plays out, how those numbers come in and how that affects the interest rate increasing.
It's probably
forward.
one of the most common questions I get in my strategies as well. Like, what do we see with inflation? What do we see with interest rates? So, like, for it to get back into its target range, even for example,
Oh, mate, we're a long way from that.
Because when you've spoken about this, and you probably know a lot more than Sammy, which is fair, about the lag effect.
More than you.
You're trying to get him to buy it? Or?
Yeah, just
more than
throwing
you.
a little.
More than you.
He's further away from
they
the
put
table.
the table along this way. I've got a really long stick. I've got a pool cue.
I feel sorry for Morgan sitting next to you. But anyway, the lag effect. Talk about that.
It takes a while for the interest rate increases to actually impact the market. It also doesn't impact the entire market as well, because not all of society has a mortgage. So you're only looking at about a third of the population that has a mortgage, a third that rents, and the other third with no mortgage at all. So the third without a mortgage
baby boomers
continue to spend.
Yeah, well, you hit the baby boomers, don't you think? That they're the ones out there spending all of their cash, right?
Absolutely.
Because they've got no mortgage. This is their peak spending, right?
Holidays, just got out of COVID. I'm going to go overseas.
Also, I think I was reading something yesterday that said during COVID, like the fixed rates were like, I think over 50%, and most of them come off between June and September. So like most people wouldn't really be affected by it yet. Like,
good call.
That's why they call it this cliff. That's why they call it the cliff. Is because, like, obviously there's a certain amount that are sort of coming off. They've only reached the peak or almost at the peak in terms of interest rates, but a lot of people still haven't come off that cliff yet, right? The actual interest rate fixed. Morgs and I, we were laughing about it like the other week because we're like, shit, we've had a good run on these fixed rates, but a lot of them were kind of coming off at the end of this year, start of next year. So it's a great point to make, because that's going to be, I think that is the big thing everyone's waiting for that to really impact the market.
So further to what you're saying, so a third of the people that do have a mortgage, and then the percentage of that are on fixed that haven't come off as yet. So you can no wonder that people are still spending, because the majority of people aren't getting hurt.
Yeah. Such a small percentage of the market that's actually feeling the impact currently. Yeah. You like you said, like 50% on fixed until at some point this year. If you have all of them drop off at the same time, you're only looking at 15% of the market.
You know what's interesting as well, and Morgs will back me on this, because obviously we were very close to you in terms of what's actually coming through on the ground, right? And essentially being on the ground. But like, the proportion. The really crazy thing is people who don't, because stock is so tight, people who aren't affected like overly and they're just willing to take their time and chill and everything, they're all taking it to market because there's so little stock. But like how many people they're coming to us with off-market deals, and the only really people who want to come to off-market have just fallen into that stressful period, and they're like, shit, it just went into it. We got hit the first month, we're like, ooh, that hurt. And then another one hit, and then they're like, oh, I can't actually afford this. Yeah, that might be, a lot of people run quite skinny on savings. Like how many people we kind of seeing on that front, they're coming stressed. Like that's where the opportunities are at the moment.
Yeah. And a lot of them have only held the property for a year or two. Like new investors that might have bought it then thinking this is great and now not really willing to ride it out.
I think that's a big one too. Even the people not on the cliff, let's say they bought it a year ago and they bought sort of, especially if you look at say Sydney, Melbourne, Brisbane, they buy at peak pricing, but even everywhere around the country, it doesn't matter where they're sort of buying. If they bought in the last 12 months, but they're super exposed to where those interest rates are, especially 12 months ago, your fixed interest rates were crap. Like no one was fixing interest rates 12 months ago. It was 18 months. And before that, everyone was fixing. So a lot of people kind of buying in on that variable, bought in the last 12 months, gone from 3.5%, on variables. Now they're up into the sixes. There's a lot of pain
especially
that we're seeing.
If they signed like a lease on a lower rent 12 months ago, they would be.
Talks about rents though.
Rental growth?
Yeah.
I mean, pretty much all the markets we've been buying and have seen massive rental growth. Vacancy rates are still really, really tight. So
what are you seeing most vacancy rates at?
Sub 1%, pretty much all of our markets.
Everywhere, yeah.
There's a couple that are 0.0, which is just
0%.
insane.
Yeah.
But yeah, since the start of the year, the rental growth has been huge. Some markets like over $200 a week, it would have grown since the start of this financial year.
Yeah, I mean, put that in perspective, $200 a week, right? So I think this is where it really comes into the equation of being savvy and especially having your buffers, because if you got buffers and you're a smart investor, and a lot of the people who'll be feeling the pressure realistically are homeowners who thought they could afford it, and at that time they probably could, but then obviously having had the run they've had, now it's changed so much. But for the investors, like in a lot of what we've seen, it's funny because I was running through my numbers the other day and seeing where they were all sitting on my own portfolio. I got a lot of these fixed rates coming off, but then I'm looking at the yields on like, I think we chatted about this the other week, and like so many of the deals that I bought when I was buying them at 8.5% yield, and now I'm sitting at like 11, 12, 13% yield because I've had $300 worth of rental growth between a house and a granny. And so yes, interest rates have increased, or they're about to come off and I'm about to get slugged by it. But it's really sitting there. It's really sitting there essentially, balancing it out, essentially balancing the sheets with that as well. So I think that's an interesting thing. And I see certain people out there going, oh, you bought this shit box, $200 a week positive, or now you're neutral. It's like, yeah, mad. And if you were $200 a week negative, now you're you're $500 a week negative, like you're seriously bleeding. Whereas when you have that buffer already built in, that's what can help you on that front.
Just for you two being in the field as buyer's agents. So I'm curious about what you were talking about before, Morgs, that a lot of people who are selling now because of they're feeling the pinch. Are they mainly homeowners or investors that didn't realize that their fixed interest was coming off and they're getting a bit spooked by being slightly negative?
It's probably still a mix of both. A lot of them are people with leases that are quite low. I don't know if it's kind of like a mix of they don't realize where the rents are at. They've had those tenants in there for 5 years, and for them it's just easier to sell it than release and try go for top rent. And then even like home buyers who potentially moved out of their home to buy into something else, and they had that as an investment, they're now letting that go rather than holding it. I think there was quite a few that had like the 2 properties just kind of waiting. Now a lot of those are like a second house that they've moved out of that they're getting rid of.
You know what I'm seeing a lot of as well? There's a lot of people, especially in areas. So we always judge a market by like how we're going in a current cycle, right? And so like how long we have left in a market, or when we're getting into a market, how early we are in that cycle. What I'm seeing a lot of is those markets that we got into that we're getting into that are quite early. Maybe they've only had in the last couple of years, 10% growth or something, as opposed to some of our markets that have been 50, 60% growth. But if you look at those markets that have had barely anything, and you look at the long-term averages, and let's say they bought 10, 12, 15 years ago, and they've had like no growth in that time frame. And now interest rates are going on a run. We're actually seeing a lot, like have gone on a huge run. I'm seeing a lot of because obviously Morgs has got her areas that she works heavily in on the ground, but obviously I see the whole team being the head buyers agent. Essentially, I see the whole team and everywhere that they're buying. And the really interesting dynamic I'm actually seeing is in these other markets that are cool, like not quite as hot as some others. They have barely moved in a 10, 15 year window, and then you get these investors that have held for that long, and they go, and especially guys that have maybe bought off the plan with a financial advisor or something, and they've gone and they've paid $400K, and now the property's worth $350, 10, 15 years later, and they're just like, you know what? If interest rates go up and this thing falls even further, I'm just going to cash out now. See you later. I'm out. And I'm literally seeing there would be half of what we buy in those areas are literally we're picking up those deals where those guys are panicking and they're going, you know what? Like I don't want to see this thing dip again. I'm gonna cash in my chips. It's risen a little bit in the last year or two. And I feel sorry for them because they don't understand the market well enough. They were just sold some dream 10, 15 years ago. But I feel a bit sorry for them because the market is literally going through a transition at the moment. It's about to take off, but they're cashing in their chips because they're stressed about that scenario and that environment.
Yes.
That essentially has come through.
There's a couple of really good points I want to bring up that you just mentioned, Morgs, about, people buying, and this is for the listeners out there, about if you do own your primary place of residence and you're wanting to, say, upgrade or sell or move to another place, a lot of people will think, I'll just convert my house into an investment property. And so the problem with doing that is that you bought your primary place of residence as a primary place of residence, and now you want to convert it into an investment property, but that might not give you the best return. So if you're out there in that scenario, what would you say? I mean, you got to think real carefully of whether or not, is that the smartest thing to do? Is it better to sell that property? What do you think? Do you see that?
Yeah. I mean, it depends where they've bought it and what the area is doing, what the yields in the area are as well. I mean, if it's a great investment, it works well, but if it's probably something in Sydney that you can't really afford to hold, and the rents are like $600 a week, but you could sell it for over $1 million or whatever.
It's always market dependent.
Yeah, and also
market dependent.
I think what I was thinking about from these calls that some of the discovery calls that we do is that you can't look at the lens of an investment property through your primary place of residence. It doesn't always translate. So don't just think, we'll just keep two properties because one will be an investment. That could be an underperforming investment.
Yeah. I think that goes back to the investment model, right? And I think it would be I think we're quite blessed by the level of quality and intelligence of our investors that listen to Scouting Australia and that work with us at Australian Property Scout as well. I don't think we have that many people because that's just a novice investor buying or investing in their own backyard. What 99 times out of 100, the best thing to do with a primary residence, it isn't to go and rent it out. It is to sell it while you have a no capital gains tax exemption.
Great.
Obviously, full disclaimer on that, no financial advice, blah, 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 or the rest of it. But realistically, most of the time, you have no capital gains on a primary residence. If you've seen a significant cycle, sell it. Go park that cash somewhere else with a better return, lower in the cycle to see a proper run. The idea of just holding forever, it was a great home, it was a great investment. Yeah, okay, no worries. It's had its run. Sell it tax-free. Let's go.
And one of the other points is about getting the market rent correctly. Like people are selling it, they're a bit nervous, it's been under market rented, they think, let's just sell it.
Yeah. Well, I know one that I've just bought recently, I think they only bought it in 2021. They've made a bit of money on it, but they've had the same tenants in from before they bought it at low rent back then, and they still haven't moved them up. So they'd obviously be feeling interest rates a lot more. But the rent probably could go up about $150, $200 to what it's on right now.
And what a difference that would make
in
this environment.
Huge.
So if you're listening, folks, and you're under market rent and you think, you know what, they've been there for so long, they're nice people. This is not a personal thing that you're trying to do the wrong thing by your tenant. But if you're incurring more costs from your interest rates, you're trying to do the best thing for your family, you're doing yourself a disservice by not pushing to get the market rent. You're not trying to be greedy.
You don't even need to go for full market as well. Like if they're a good tenant, go a little bit under. You're still looking after them, but you're also looking after yourself. Because the worst thing you can do is put yourself into a spot where you have to sell it at an inopportune moment. You want to make sure you're keeping it. If they're good tenants, look after them. But at the same time, you got to look after yourself on that front.
Yeah, I agree.
Lukey,
all right, Lukey.
What else you got, buddy? Or is that it?
I think that was it on inflation. I think we covered it.
I think we nailed
Inflation's
that.
done.
Well done, Lukey.
Inflation's done.
We're out of time. Guys.
Done.
Thank you.
Wrap it up.
What else you got, mate?
What I was going to compare that with, though, is wage growth. So wage growth up to the March 23 quarter was 3.7%. So that's
less than half.
Yeah, correct. Less than half. So if you've got the cost of living going up by 7% and your wages going up by 3.5%, that's where there's all this cost of living crisis being spread around, and it's not being spread around. It's the truth. Like people are struggling out there. Grocery bills. I know I've got 2 kids. The grocery bills are going up. You know, it is being seen across the board. So wage growth is very low in comparison to inflation. Inflation needs to come under control because that 2 to 3% target range will be perfect. If wages are going up by 3.5,
beautiful.
Inflation's at 2.5, people are moving forward. So that's the ideal situation.
Very interesting.
And so what can we do with that? I mean, you know, when you talk about wages growth, it's obviously sitting below inflation, but what we want people to have a practical approach to this. You can listen to the data and you can just say, well, wages growth is wages growth. But what can you do in your own situation to try and boost your own wage or salary to increase serviceability? We talk about this all the time, right?
All the time.
Controlling your controllables, try and do whatever you can to improve your situation.
And I think the other big thing is if you are already an investor, exactly the point we touched on a second ago, make sure you're keeping in line with your market rents and all the rest of the sort of stuff as well. The worst thing you can be doing, you know, you're busting your ass trying to push for a $5,000, $10,000 a year pay increase, but you're doing yourself out of, you know, $20, $30, $50 per rental. If that's over the 3-4 properties, it could easily equate to $10, $15K a year that you're in terms of lost rent there. So I think, really staying ahead of the curve with that and trying to keep on top of that.
And you've often spoken about how to, you know, on our cash flow one, how to increase your own income. Yeah. Like ask the question, you know.
What can I do?
Everyone got stuck into the what's his name? The RBA.
Philip Lowe.
Yeah, about what did he say about to increase your income? He said, go and get a better job or something. I don't know, everyone blew up and all that. But if you really...
That's a great white shark, that comment. Fucking hell, mate, you're about to get taken out. You're a bit of a dugong. Look at your head, but mate, that's a great white.
Everyone got stuck into him, and you can see why
You can see why, that's for sure.
Yeah, but then if you strip that back and you really just think about it, and it's not too dissimilar to a lot of the things that we say. Well, if you complain about wages growth, how is that going to help you? That doesn't change your circumstances at all. So trying to create, like when we're reviewing the data and giving people things to think about, what can you do? Like what can you can't control the stats, but you can control getting off your ass and maybe looking for another job that may earn more money. It's going to be a pain in the ass. You got to get your, whatever it is, you call and this and that. What can you do? All I'm trying to get is people
100%.
to take ownership of
it's selective
to do
data
something.
too. Like your 3.7% is nationally. There will be people out there that had a 20% pay rise last year.
Right.
So it is obviously dependent on your job and what you do as to your pay rise and sort of where you're going in your career. But 3.7 is a national average. Obviously, not everyone is going up by 4%. Some people are 10, some people are 20, some people are 1. You know,
so nothing.
This was a great segue for you to ask for a pay rise on the podcast.
Absolutely.
Declined. You know, we're actually it's a bit tough. I've got to cut a few wages here. I was going eeny, meeny, miny, mo. Fuck off. You old dog. All right, what else have we got, Lukey, mate? Let's punch through some of these questions, mate.
Perfect. So population growth was the last one. So population growth obviously will lead into our stock.
Yes.
But we'll do that one shortly. But
give me some numbers, mate. Throw some numbers at me.
One of the key ones I saw was current population of Australia is a bit over 26 million. So the Australian Bureau of Statistics are forecasting Australia's population to crack 30 million, but some point between 2029 and 2033.
Wow, that's huge.
So it's like 3.5 million people.
That's huge.
Yeah, so not too far off.
What's like 6 years, six to 8 years.
And of those people, Lukey, most of them skilled migrants?
Correct. So to the year leading up to December 22, 387,000 migrants, skilled migrants coming into Australia. So obviously that has affected stock, which we'll go into a little bit in our poddy on that.
Can you just clarify for people listening, when they hear skilled migrants, they don't it doesn't compute because people, I mean, a lot of people aren't tracking
It's like
this.
Jimmy, but skilled. Done.
I'm here already. So
he snuck in under the border.
He swam under the border.
Well, I am south of the border anyway, from Melbourne. Lukey, can you just clarify for the listeners out there, when you're talking about skilled migrants, people coming here, I mean,
people that are skilled, basically people that have a professional career over
trade background,
engineers, nurses, people that are skilled in their specific fields. We have a massive labor shortage in Australia at the moment, so I don't see those numbers decreasing anytime soon. I think they will rapidly increase.
Well, that's why, like at the moment I was hearing, like they were pushing through work visas in like 24 to 48 hours because there is such a labor shortage in Australia right now, like literally 24 to 48 hours to push visas through for those. And it was actually hospitality and hospitality because hospitality was like so down because during COVID, literally there was people weren't going backpacking because you couldn't get into Australia, and backpacking was like those people, they'd come over and they'd work in those, they'd live somewhere for 2-3 months and work in the hospitality at your cafes and whatnot. That was dead. That wasn't anywhere. And so hospitality wages actually went on a ridiculous increase because there was no one there to hire. Right. So they're trying to hire and they're getting all these nufties. But realistically, no offense to Jimmy, but this is what they had to do.
Well, many places were closed because they didn't have staff.
Yeah, exactly, man. Yeah, literally they closed because of it. So I know they were pushing through the work visas for trades, and for that because huge shortage on both those fronts.
But
so
even like with your point on backpackers there, like even fruit picking during COVID, there was no backpackers in Australia.
Yeah.
There was farmers. I remember the story came out about blueberry farmers. They were like
dumping it.
Yeah, they were dumping their stock because they couldn't get enough people to pick it and pack it. $2,000 a week they were offering people $2,000 a week, and that. No one wanted to do it.
And as many blueberries as you can eat. What a gig!
Jimmy tried to apply, but they were like, "No,
too old. Too old."
Well, good antioxidants for your age. So apparently, they're good. They're good for your health. But when you're talking about all these skilled people, if people are out there thinking, you know what, I'm just going to wait because, well, how does that affect me? Well, these people are earning. They've come to the country. They got a great skill background. They're going to be earning good money.
They're going to jump straight in and get a job.
They're going to get a job, but they need to live
houses.
somewhere.
Yeah.
So they're going to take stock out. Yes, they'll rent at the start, but eventually they're going to buy something.
Yes.
So then that's just going to exacerbate the problem.
Yeah.
So if you're sitting out there thinking, you know what, it's all too hard, I'm just going to wait.
We're going to go into stock levels in the next in depth, right? But I can tell everyone right now, the stock shortage is not going to ease for about 3 years. I reckon we've got 2-3 years minimum before stock is properly back to equilibrium. So that's why it's an entire episode in itself to unpack. But there is a lot of things. And population growth is one, it's kind of the cherry on top compared to everything else that's there as well. So there's a huge amount to unpack there.
What else we got, Lukey?
That's it for mine.
That's it. Sammy, do you have any?
Well, so that's the numbers, right? So that's the stats on everything at the moment. Look, one of the other big things I'll throw in as well, obviously that kind of came and actually went, was the Queensland land tax as well. That was actually a massive talking point. It was a really interesting thing because we're talking about stock and markets cooling off, right? When they brought that in, there was all these triple whammies that came in on Queensland, especially Southeast Queensland, which had a hectic run. You had interest rates obviously went on a run. COVID had eased, and most of the country by the start of last year came into this period of, not needing to actually move and transition out of areas.
What's COVID?
Yeah,
it doesn't exist anymore.
Jimmy looks like he's just been ravaged by it, but I don't know.
I'm looking pretty good, I thought.
Yeah, for a COVID-ravaged dog. But anyway. Seriously, but you know what I mean? Like 2 years ago, we couldn't move without it, and now...
Masks to go into everywhere.
Wow.
I haven't seen a mask in a long time.
Mate, I have not either. But so you had COVID easing, you had interest rates up, and then you had the land tax brought in, Queensland land tax, right? Brought in on that end as well. Man, that triple whammy, it just stalled most of Queensland's markets, and especially like you look at the GC and you look at the sunny coast and obviously Brizzy in the heart of that as well, that market just got stalled because of that. So much uncertainty in the market. And for those of you guys that don't know what it is, this is obviously actually pre-podcast, so we weren't even talking about it on terms of on a podcast back then. It essentially was Queensland state government were looking to kind of amalgamate all properties you had in all states and put it under the same banner of Queensland and charge you your land tax off the back of that. It was ludicrous. It was absolutely...
suicide, political suicide.
Man, it was crazy. I couldn't believe it. And what happened was a lot of people tried to sell out because they couldn't afford it. When everyone calculated their land tax bill, it was astronomical. So a lot of people who swore they'd never sell were looking to cash out or did cash out. And a lot of people didn't buy into the markets. The only people that did were home buyers because rents were starting to rise because investors were cashing out. And so, again, that is one extra factor that depleted the stock and the especially rental stock in Queensland. And so it was a very, very interesting thing. I actually called it on a few big podcasts that I was like, I honestly believe this isn't going to stick around. This is going to change. And they did. They overturned it in a few months after. Probably, I think it was about I can't remember the exact numbers, 3 to 6 months after they implemented it, they overturned it because it was causing some serious problems.
Okay, well, one question apart from the stats, and that was awesome, Lukey. Well done for that. That was really helpful. But in terms of for you two as putting your APS hats on, I'm curious, and if you could just give us a bit of a recap about how did Australian Property Scout change the strategies during the last 12 months. Can you just give us a bit of an overview? We're doing a bit of a recap. I'm just curious, because the market conditions changed. Did you change your strategy in accumulating properties?
Look, realistically, man, a tried and tested method is what you stick to, right? So like something that works all the time. It works in all markets. Okay, so obviously great growth location, making a margin on the way in, and then obviously, carrying them through like that and buying in those sorts of markets, and obviously pairing those up with cash flow deals as well. The model and the formula never changes. It always works. The one thing that we had to change tack with, we actually changed our offering a little bit at APS as well, really actually came in and around stock, which I know, again, we're diving into next week. But because stock is so tight and there's actually so few deals around at heavy discounts, which is what we pride ourselves on, we actually had to change a little bit of tack on that because so many people are trying to get into the market everywhere, right? And people are coming to us. We closed our books for a little bit there because we kind of got a bit stacked out and there was no stock. And so what we actually ended up bringing to the table was a different offering of people still offering a bit of a discount, but not the same level, kind of like the APS trademark, 20, 25K plus. The amount or the volume of deals that we could do on that front was so limited because there's no stock around. There's only so many people under financial pressure at the moment. Obviously, that might change in the next 6 to 12 months. But at the time, there wasn't, there hasn't been that much. So we actually had to change tack a little. And a lot of people actually appreciate it. We change a little bit on that front. Instead of having a longer sourcing time and finding that discount, obviously shorten up the sourcing time and take a lesser of a discount on that front. So instead of going for 20 plus, we're kind of going for 5 or 10K, but getting him into a market straight away as opposed to that longer wait. So, man, that's probably the only real big change and big challenge that we had. We're obviously trying our hardest to kind of keep it to that level, and we still do that. But it's a trade-off, and the other big thing that came with it was people, a lot of people kind of were coming in and they couldn't actually wait that long because of the interest rate rises being so rapid. Their serviceability was dropping so rapidly, they actually couldn't buy. Like, let's say 2 interest rate increases come through, I actually can't service anymore, or my servicing drops from 400 to 250 or 300. So what we were kind of finding was a lot of the time the speed of actually getting into those markets quicker was a bit of a game changer for a lot of our clients, both in terms of getting the growth sooner, and also not missing out on that opportunity before interest rates went too far. So it was an interesting thing, and it was a hard thing for me to stomach because, like I say, APS trademark, like it's literally something that I hold super close to the chest. You've known me for a while now, how I operate with discounts. But it was something that we had to change and react to a market where, man, if we're talking stock, right, nationally, I know we're going to talk about this next week. I'll talk about the numbers here, right? And I keep saying we'll talk about it next week. But if we talk about it, stock nationally across all cities, the whole nation as an average, 20 to 25% down stock on stock in 1 year. 25% in most of the markets that we're in. We're somewhere between 50 to 70% down on stock from 12 months ago. So 12 months ago, a lot of our markets, days on market, were like 20 to 25. Most of our markets are like 1 to 3 days, 1 to 5 days, like max.
It's insane.
And in reality, that's just until they market as sold. They're selling in the first day or first 2 days. Actually, Morgs, you got a crazy story about a deal from last week, right? Like they listed $399 plus and sold it in 4 days. What was that?
It sold in 4 days for $468, and it
listed
had
at $399.
Yeah.
Yeah, sorry.
4 days, $468. It had 67 offers and 21 registered bidders on like an online auction.
Insane.
Yeah.
Insane. And that's the power at the moment of going to market, right?
But was that property undervalued at when it was listed, like at $399?
Yes.
Was it?
So our at the time our market appraisal on it was probably around $430, $440. So they listed at 10% under. They're trying to be cheeky about it. It's a very what's the old saying, like price it low, watch it go, or whatever it is. Yeah, list it low, watch it go, whatever it is, right? But realistically, market value was like $430, $440, and it sold almost 10% above that. So it's crazy to watch that dynamic going in there of things hitting the market and how quickly. You got to remember, man, it's not 1 or 2 people, which is 21 registered bidders.
That's insane. Yeah. And I know, Morgs, you've had to pass on a lot of deals in your areas because it didn't reach that minimum 20K that APS prides itself on, only to see those deals when they did go to market or did sell were grossly, how much more expensive were they than the deal that you could have potentially actually got them for?
Yeah. I mean,
you sent that list out to the team.
I'd have it off market and say no at this price because I could see there was value in it, but the comps because it's moving so fast, like the comps that are available to look at and call as your solds don't really justify it. And then it goes to market and sells for like another 10%. In most of them, it was anywhere between 15 and 50,000.
Jeez.
Yeah, we legit, man. We had ones that we knew buyers agents bought them. We turned them down like 485, knowing let's just say that as a number 480, because I think there was one you sent me a 480 something, 485, right? And we knew market value was about 510, but 25k in it, and then another BA comes in and pays like 530, 540, 550. He's just like, are you kidding? And I'm not kidding. Like, I'm not just saying this. Like, this happens every day of every week, and the team tells me, and I'm throwing haymakers at walls because it's just driving me nuts that they're overpaying for these things.
Because then it sets a new precedence that the next time, like, now I'm that little bit more, so you never get that opportunity to kind of source it at that money again.
We actually had a couple of clients where we did, I think, like that exact example, we got a couple of those deals. I think you got 2 at 490, and the clients were like, "Oh, we're struggling to see the value at like 520," and we're like, "It's 520." Like, you know, you try and send them what you can send them, but so much it hasn't actually settled yet, and so you kind of give them a couple of call these agents and ask them what they sold for. But we know what they'll tell us because we're in the same industry. Not going to kind of pass it on, but until that's properly unconditional, they actually can't a lot of the time tell the average punter what it sells for. But then you see the same things listed and they start selling 530, 40, 50, literally within like a few weeks of us going uncon. So the speed of these markets and how quickly they're moving, it's why we had to make that natural transition, because we're in like a never before seen stock level environment. And so, yeah, man, it's just a game changer. This is crazy watching at the moment, the jump and the rapid move in markets.
And when you think about just the numbers, I mean, without harping on it, but if the difference between getting it 20 grand below market and 10, let's just say that's 10 grand, right? But if you're letting that go and you're waiting an extra 2 months to get into the market, surely
it could do
10 grand
20,
is
30, 40 grand.
It could do if it does at least 10, you're breaking even. But if it does 40, you're already behind.
Yeah, exactly. And so that was the tricky dilemma that we fell into. And that's why I said it was really hard for me to make a change. But we spoke about it as a team. We're just like, it just makes sense. And it's just like you offer it. They don't have to take it. But like if you offer it almost as like a service, and it's like these are the options, the opportunities that kind of are there. Because this is the ratio of kind of where it could move in a flat market. I don't believe in paying market value. I don't believe in paying 10 under. You know, in a flat market or a slightly rising market, I'm still firmly believe on my 20K under, 20K plus. Flat market should really even be more, because the whole idea is to make half of your deposit back on the way in, right? If you can make that, and then in the next 12 months, you get 10% growth, bang, you pull your deposit back out. But in these markets, to get that much of a discount, it's just so scarce. You know, the scarcity of it is crazy. So
I think that's the key is the market, right?
Sorry, I didn't mean to cut you off there. That's exactly what I was just about to jump into as well. It's not everywhere. It's condensed markets, certain markets that are on that rapid trajectory. And we've had them before where I've lost so many deals. We had it in Brizzy when Morgs and I were buying in Brizzy, and it was going so hard. It was in 30 to 40% a year. And we kept missing on deals because at the time,
we're
running
trying to get like
30. We're running on the 30
discounts.
minimum discount, and it was just impossible.
And the agents are just like laughing at us.
Just
Like this other guy's come in and paid 50K
we just had a BA
more.
offer us 50K more than where you're at. Like, it's just crazy, man, crazy.
And so looking beyond that, right, just looking at, because as part of the recap, how big would you say fear for investors over the last 12 months? I mean, you guys speaking to investors every day, and you too, Lukey. I'm just curious for people just to look at this retrospectively and think about, okay, so who are the winners, who are the losers, and also with the goal to give people a tool to look ahead for the next financial year. So in the last 12 months, what would you say? What were the winners and the losers in the market of investing?
The winners and the losers? That really all comes. Are you talking about actual location wise or investors?
No, I'm just talking about people, like they took action or the people who.
Winners are APS clients.
Great
a bit
answer.
of a plug there for Australian property scam.
You want a bonus, mate? That's how you get one. The dirty dog. But yeah, man, I think that's a great point. You know what I mean? Like literally getting into the right markets, you win. You know what I mean? You get into the right market 12 months ago. Some of our markets are up more than 30%, 30% in growth. You know, so not even counting the discount on top of it, you're literally up 30% in terms of growth. And I think that's the thing is like there has been a lot of fear, but man, I think, and you're on the front line, like you do our discovery calls, right? Discovery call strategist. But essentially, man, like you would see majority of people are quite okay. You know, at the moment, there's still a fair bit of bullishness and I think we attract that certain amount of people that are willing to have a go and to get out there and really have a crack at it. And man, like I love that because when the most money I've ever made are in the markets when they're dead. So 2019, before the election, I was buying up. COVID, low doc lending in trust went so hard, it's not funny. could have crippled myself if the market tanked. Didn't, went the other way. You know, and then all these little windows where the fear is out there in the market, you take advantage of that and you get out there and have a good hard crack at it. Mate, that's the time you make money. You don't make money when everyone is trying to get in everywhere and there's so much hype everywhere and it's on the news. Oh, the market's booming. So you're competing with the masses. It's so hard to really make a lot of dough in that. But you make it in the down markets and when there's fear.
That at the moment, that's probably the most common question I'm getting in a lot of the strategy calls that I have with clients. And they're basically saying, is now still a good time to buy? They're basically saying, I know there's been a lot of growth, but is now still a good time? And I basically walk them through exactly what Sam just said. Fear in the market is massive. So at the moment, there's a lot of fear. There's no good news. There's no inflation's under control. Interest rates are coming back. A lot of people sitting on the sidelines waiting to see what happens. As soon as they get good news, a lot of them are going to jump back in.
Piling back in.
They'll be piling back in the market, and they're great comparable sales for people that have had the confidence and the support around them to buy when the market is very fearful. It's very corny, but Warren Buffett is very famous for saying you buy when the market's fearful and you sell when they're greedy. So at the moment, over the next 6 to 12 months especially, there's a lot of fear in the market and it is a great time to buy. But buying in the right location is the most important part.
That's right. And would you say that, I mean, basic economics, and you're the economist, but supply and demand, like interest rates don't control or dictate pricing, right? Whereas the basic supply and demand, and you mentioned before,
this is stock levels.
There's going to have
going back to stock levels.
Yeah, 6 million people, or however many more million people are going to come in. I mean, there's no wonder what's going to happen, right?
Correct. 3.5 million more people coming into Australia.
Correct him, Lukey. His memory's going a bit there, buddy.
Yeah, however many. Yeah.
6 million.
They're in the millions. It's in the millions.
He's talking about his head's too much around his portfolio now. He's telling me his portfolio's at 6 mil before. He's getting excited.
Exactly.
6 million pesos.
It's like about $100. $100. A couple of meat
About
pies.
$100.
Couple of meat
Zimbabwean
pies.
dollars.
A Gatorade.
Go on,
Don't
Lukey.
get me started on Zimbabwean dollars, mate.
Or on pies. You love talking about your pies.
Oh, I do come down to Sammy and on the way home, Yatla pies. Give them a plug.
A bit of a plug. Yatla plug.
Yatla pies are good. There we go. They got the drive-through. You drizzle a bit of Tommy sauce on it. Bloody beautiful.
Can't go wrong.
So anyhow, you were saying.
No sidetrack here. 3.5 million people. They've got to go somewhere. And we are just purely not building enough properties to keep up with the demand. Obviously, supply and demand is massive in the economy, but 3.5 million people have to go somewhere. And you go and look at, obviously, stock levels being the lowest they've been in a long time. We're not building. There's less building approvals year on year. I think it's going to get a lot worse before it gets better.
Which is the outlook we want to leave
100%.
people as we wrap up the pod. I mean, we're nearly there, but
Almost there.
what would you say to people? We've done a recap on the previous 12 months, been pretty intense.
Yeah.
Moving forward, practical things for people to consider.
Practical things, have a look at your own portfolio. So I think the biggest takeaway, there's so many things we've spoken about here, but the biggest takeaway is interest rates. You know, you got to have a good hard look at your own portfolio and where they're currently sitting, and you got to run that against your income. So if you're a low income earner, a medium income earner, and you got heavily negatively geared properties, you've got to have a good hard look at that. Have they done their dash? Is it an okay time to maybe sell, redeploy? Because one of the big things I always talk about is, let's say that example I gave before of, let's say you got sold down the strategy of blue chip or something, and you've gone and bought something $5,000 a year negative. That $5,000 a year is now $15,000 a year negative, or $20,000 a year. How long can you hold that for? But how long is it actually worth holding for? If you have to hold for 10 years until your next proper upcycle, it can be $150,000, $200,000 in the gurgler before you even start. Yeah, that's a big loss to then try and start from. If the right thing would be to maybe sell it, maybe you've had some capital growth, you sell it, you cash out of that, and you get started again somewhere else. That's where I think, like, you should always be assessing your portfolio. Like I just said before, Morgs and I were a couple of weeks ago drawing out all the new numbers, checking where everything was, assessing interest rates, assessing cash flows, updating rents. You should be doing this continually, whether you got one property or 100. It doesn't matter. You should always be assessing your portfolio and looking forward. I don't think the next 12 months is for everyone to get into. So if you're in that scenario of what I was saying before, and you're a lower income earner, maybe and you copped a heavily negatively geared portfolio, if you're not prepared to sell, I don't think you should be looking to buy, because there is that with where interest rates are at the moment, extremely hard to get positive cash flow deals. Obviously, if you're doing manufactured cash flow, we can generate cash flow and build on that end. But for the most part, that can take 10 to 12 months to fully execute and get that back anyway. So I think, like, you've just got to be, like, the biggest takeaway I would have is properly assess your portfolio. I literally say it all the time, but it is so important. Properly assess your portfolio. And and then that's for those guys. Anyone who doesn't have anything, what's actually holding you back? Because if you've got 50, 60, 70K in the bank and you're a low income earner, you know, you can afford to right now we're doing deals at 300, 350 and they're still running neutral, slightly negative, slightly positive. They're kind of sitting around there. If you haven't started your portfolio, this is the time. Let's roll some dice and have a crack and start to build something out. Because like I said before, this can be a great time to really build your base and build your foundation when other people are scared. In the next 12 to 18 months, you could quite easily build a 2-3 property portfolio that maybe doesn't cost you much, or maybe it costs you $5,000 a year to hold 3 properties. Perfect. So I would be looking for all those different opportunities and windows and like assessing everything and like, what is the game plan from here? Do I hold? Do I sell some? Do I keep accumulating? And I think it's not for everyone, but I think if a lot of people have a good hard look, there is a window of opportunity for everyone if they take the right steps. Lukey?
I agree.
Morgs?
I don't think I could. Everything you said was pretty much what I in mind to say. So, and that's what I'm talking to people about in strategies. And I've said it before. The comparable sales for people jumping in 12 months, 24 months time, when everything's good and dandy, very sunshine and rainbows, they're going to be paying market value and above. You bought in market value slightly below, and into a hot market, you get the yields as well. There's going to be a lot of opportunity there.
Can I tell you, there's a story, right? There's a young fella that works for us now called Big Terry, right? Terry Rizakis, legend. Love the bloke, right? He's a young fella from Adelaide. He was a plumber. He now works within APS. He's an associate BA. In COVID, he was adamant he was going to work with us. And his dad tried to talk him out of working with us. He's now, he's three or four. I think he's about to go for his 4th property, right? 4 properties in. He was on $60K a year. In a 2-year window, he made about, it was like $550,000, $600,000 in equity since 2 years since he'd been working with us. And his old boy said, don't do it. Don't buy it. It's COVID, man. Like the market's going to crash. He's his old boy. Now, he's a young Greek fella. You listen to your family, right? You would know this, Jimmy, from the ethnic backgrounds. Like, seriously.
It's a lot of pressure from your family.
There is.
Absolutely.
And he's like, nah. He ended up not telling him. And he just did it. And he bought it. And then it was an excellent buy. It was
he knows now, right? He's not going to find out in this podcast.
No, 100%. No, he knows. No, he knows. But like now his dad's like extremely proud of him because he backed himself and he put the balls on the line and had a good crack at it. And he's done exceptionally well off the back of it as well. So, hats off to people like that to have a go. And this is where it's like, it's opportunity. If the opportunity is there, man, you gotta go for it, So,
which circles back into we talk about it all the time about your circle of influence. If you're asking questions of your family or your friends or something, take it with a lens or a grain of salt and ask yourself, are they investors? Are they giving me advice?
Have they done what I'm trying to do?
Exactly.
And if they haven't, as hard as it sounds, bin it.
One thing I wanted to bring up a bit earlier about interest rates, and if we don't mind just circling back, because there's a few clients that are actually asking this.
Okay.
I've got a scenario. I've got my loan on fixed interest.
Is this the old I'm asking for a mate question?
No, it's not about me.
Okay.
But if I'm on fixed interest, like you're talking about opportunity and you said in 12 months' time, you're going to miss out on the opportunity. There's a lot of buyers out there or investors that have got fixed loans on their mortgages.
Yep.
They don't want to refinance them because they don't want to pass on the 2.8%, but they don't want to buy into the market until they mature. But that means they're going to wait another 6 months. Mm-hmm. What would you say to those people?
So I think you got to have a good hard look and a good hard assessment of the portfolio. The first question I'll be asking is, can we leave the fixed rate and refinance and take the cash out as a separate equity release on top? Because a lot of the time you can, as long as you can still service that lender. A lot of the time you can. It always comes back to assessing the actual property itself. Is it still in the right market? Is it potentially the time to sell? Or is it the right time to hold? And if it's the right time to hold, and you can't get the cash out, and your interest rate is at 2.5 instead of 6. And you're 6 months away from breaking it, 6 months away from it ending, have a look in 3 to 4 months. If you go through the refi process there, you might break it for a month or 2 months in terms of cutting it, and you still be into another deal by the end of the year. So if that's super important to you and you have to break it, how long can I leave it before it's worthwhile doing it? Because if it's significantly less, I know it can hurt from that front. But even then, it always comes down to opportunity cost. What's the most important thing to you? Is it buying 2 more deals this year? Or is it saving $5,000 in interest over the next 6 months? And I think that's where it always comes in, and really kind of, I guess, assessing it on that front as well.
Because I know we can't give advice, but is it fair to say you're not going to get wealthy by trying to not pay?
No. It's like saving, it's like the saving your way to retire. It doesn't happen. Like sometimes you got to roll a dice a little on that stuff. But that's what I'm saying. You can be a little strategic with it, stretch it out a little bit. You could get your pre-approvals, work up the list with APS, and then break your loan towards the back end to get your cash out, all those sorts of things. Okay. So.
Well,
Jimmy, what's your takeaways
from this last financial year?
Mr. Opportunity. Morgs, what's your key takeaways?
I think the population growth is really exciting to hear about.
That blew your mind a little?
Yeah.
Yeah, I actually didn't know it was going to be that big either.
Yeah.
Thanks, Lukey.
No worries.
Great stats, Lukey.
Jimmy?
No, I genuinely think for the fear out there, I think it's crippling for a lot of people out there. They're too hell-bent on focusing on interest rates, the doom and gloom, and listening to the mass media. My big takeaway for people, and I'm just following from my own actions, is take action, take a bigger view of what's actually happening here, folks. Don't get caught up in the narrow what's in here and now on Channel 7. You got to get educated. This podcast, if you listen to the end, you're already one of the very few. So for me, it's don't follow the herd.
Yeah.
If you actually do the opposite, you're probably a very, very, very good chance of being successful.
Yeah.
So I'm going to be going quite aggressively personally because I feel the opportunity's there. And I believe in time, like we did with COVID, we will look back and go, gee, that was a great opportunity to get in.
Yeah, 100%.
That's how I see it.
Yeah, man. I'm with you, bro. No, I think that's good. Beautiful, guys. Look, I think to wrap up, the one thing I would love to run through is actually the stats and the numbers on Scouting Australia.
On the podcast.
The poddy, man. Like, obviously, like I know we haven't even been in for a full financial year, right? But I think what I really love, man, is kind of looking at these numbers and kind of how it's growing. And people are taking, our advice and what we're asking them to do, which is obviously sending it on to people who, if you're taking great value or you see someone else you think might really love the app as well, sending that thing on and sharing a bit of love on that side and helping build that base and build the community of people that are thinking on the same wavelength as you. So, mate, last month, funnily enough, May, we actually hit over 20,000 downloads, first time ever in a month, in a calendar month, 20,000 downloads. We actually hit a little over 22,000 for the month.
Was that thanks to Morgan?
I think it was Morgan's. Yeah. I think
it was Lukey's one.
Lukey's one? That's attracted. Actually, we lost some numbers because of that.
It was minus 100.
It's the new Calm meditation app, the inflation topic. It'll send you to sleep.
Oh, mate. Anyway, so we hit that. As a total, guys, we're over 80,000 downloads for the life of the poddy, since mid-November last. I think 21st of November was the first ep. So we're 7 months in, over 80,000 downloads, which has been awesome. I think our first month was 4,000 downloads in a month, which was epic. But yeah, now we're up to that 22 for the month of May. So some crazy numbers. And I actually want to ask you guys, what were your firstly, actually, massive thank you to, sorry, Morgs almost blew you out of your chair there. Firstly, obviously, want to thank the listeners, for tuning in and staying consistent and regular for us. That's been huge and obviously massively appreciate that. But in terms of you guys and your favorite apps, Jimmy, I'll start with you, mate. What's your favorite app been?
Well, I'm not just saying it because she's here.
Yes.
But I was very inspired with Morgan's app because I knew it took a lot for her to get onto the podcast. And Morgan's quite quiet and reserved, but I was just so proud of not only, it was great to hear your story, and I knew the impact it would have to many of our listeners out there. And there's no surprises why it was one of the most rated, highly rated. So that was awesome. I thought it was just brilliant.
Yeah,
so
100%. No, that's awesome. Lukey?
I think mine was Circle of Influence for the year.
Okay.
I think
second ep ever.
Yeah.
Wow.
Because it's so
important. It was all downhill from, just quickly, it was downhill from there because we started, that was episode 2.
Episode 2, yeah. So
he wasn't happy with any other one.
Wow.
Start at the top and decrease from there.
That's how Jimmy works. So I'm going to start with a big performance and just disappoint you for the rest of your life.
Got a weak finish. So that was it.
Work everything.
No finishing.
But did you relate to that? Was that because
a weak finish?
The Circle of Influence, was that because you, from your own experience? Or?
Yeah, absolutely. I think having people you can talk to about certain things. I know I bored people to tears, a lot of my friends, with things about the economy, things about property. Yeah, you too, but also having people you can talk to and bounce ideas off is massive, and building a circle of influence around yourself and your family and friends so that they're learning, you're learning, can be massive, and then you're bouncing ideas off each other. It's a really strong concept and something Sam and you have sort of kept going throughout the podcast, but taking you back to the start, that second one was really important. Building that circle of influence is massive.
And just on that, sometimes people will say, I just don't have a great circle of influence. And so they can use that as an excuse. And I get it, right? It is hard, but you can be the start of your circle.
100%.
So you don't wait, if you're listening, don't wait for someone else to inspire. You can be the person to inspire your friends, your family, and then collectively you'll get that back. So focus on what you can control.
If you help level up the people around you, I guarantee it'll take you to the next level. Because if you were in front of them to begin with, and then you're bringing them to you'll want to like start going higher than them, you know, like it'll keep, and you're going to be able to have more high level conversations as well with people that you actually care about and helping people as well. So I think that's one of the coolest things that I think I've been able to witness and experience as well in my whole journey, has been seeing other people, even like us, you know, like it's always an upskill from that end of us getting in the rooms and talking about all this different stuff. But even my other mates and stuff that I've sent it to, and then sometimes you know, you're beginning at the start and you're kind of showing them how to do all this different stuff, and hence why the podcast in my mind is really good for that, because it's got the foundations down pat like across the board. So yeah, man, I feel like it's such a massive part when you can build the influence, the circle of influence around you. It can be game changer for you because it can make or break a lot of people's journeys, you know. So yeah, I think that's a great one.
Well, think about Terry, right?
Yeah.
If he had listened to his dad, imagine now what he'd be thinking. He wouldn't be working here with APS, right? Or buying properties, obviously. But he would be kicking himself. He'd be thinking, you know, and you'd be resenting his dad.
Yeah.
So,
and how many people are out there that are like that, you know? Or they just stay stuck in the rut, you know, down doing.
And if you are one of those people that is thinking, shit, I missed the window, don't let that be your story. There is another day. What can you do today?
There's always another door. There is always another window. A market peaks out. There is another market starting its cycle. There is always opportunity. I remember thinking this about 6 to 12 months. I think it was about 6 months ago, going, shit, like all the markets are like cooked or getting close to cooked. What do we, and then I just had to go deep dive into research, and then bang, found all these new areas. I was like, okay, these will stack up. Always opportunity, always things you can tap into. And it's just a matter of looking, opening the doors.
Even if you think about it, in 10 years' time, will people be making money from property? Yes.
Yeah.
So
you might not, but.
Well, not with you. But there will always be opportunities, right? So anyway, Morgs, what was your favorite app?
Probably the portfolio breakdown of Sam's, especially I think it was the most recent one where you really went through like the struggles that you've had with your portfolio. Now that I'm getting into that like next stage of building where it does get a little more complicated, I think it's just good to know what you've been through, because as much as I kind of know, I don't know in that much depth what you've actually gone through.
Yeah, I don't think I've ever. Oh, I haven't. I've never really talked through a lot of the stuff that happened there as well. When we kind of really peeled back the onions of that one, there was like a bag full of onions. It wasn't one onion. There was about 50 of them. You know, like just like peeling back all the different layers of that strategy. So no, that's cool.
What surprised me, actually, it's a good point, Morgs. What surprised me was your ability to negotiate that early in the piece in your journey, and the deals that you did purely on the back of having a big set of
cojones.
Yeah. And just having I remember you said, it was a really good line. You said you're trying to draw a counter. And I think that was just such a gem when you're negotiating. You're just trying to put that low ball just to see what they come back with. Yeah. And those deals set you up.
Bro, 100%. Yeah. That was actually funny. That was the longest ep we've ever done. Was that monster?
It was huge though. That was massive. Yeah. So that was that was a good call, Morg. So that was very impressive.
Yeah, thank you.
What about you?
For me, it was a tie between Morgs's, which was obviously super inspiring. But the other pairing, I love the investor stories. You know, I love hearing about people winning. And so Morgs was just so aggressive with her approach and just like trusted. It's funny, like trusted what we do for clients just implicitly and just followed that structure. You know. But the other one, the big one for me was actually big Lukey Montgomery. 250. If you guys go back, look through the archives, it would have been, I think, about Feb or March or something like that. From 250K loss on his first deal to it was like 600,000 in front. He didn't let a $250,000 loss stop him from continuing to build the portfolio. He turned it around and he came and started working with us and literally turned it around and got himself that far in front. Now he's, four properties deep, about to go into his next two as well. And yeah, man, just dug deep. Didn't let, like so many people, 250K loss, property is the shittest asset. I'm never going to touch it again. Just realized he'd done something wrong, went and tried to consume as much content and as much educational material as possible, then found someone he could be mentored with and work with, trusted that person implicitly, and then just shot himself. In 2 years, shot himself to the moon. That is not in the foot like you would, shot himself to the moon, and it was amazing. So like I love those two stories, of Morgs from her trajectory, but him starting from that far behind and then turning it around into where he is now. It's inspiring shit, man. I think that's what I love the most about. There's two things I love about this job more than anything. It's obviously sourcing the deals. I love the hustle of getting a deal and getting a deal at a great deal. But then also like helping people go on that trajectory and taking them to a different level or showing them what they've never seen before, and really crafting and building that out. I think it's honestly, it's like unmatched, being able to help people with that. So yeah, man, that would be my two. It's a tie for me. It's those two eps. So it's I mean,
there's so many synergies, right? Because you're talking about Luke.
Yeah.
And you're talking about circle of influence. Luke's decision to engage APS and to speak with you changed his whole outlook. Terry changed his whole outlook.
Also with Lukey, it changed his whole family because Lukey's done 4 deals. Liam's done 3 deals. He's done 5 deals now, Liam, since that other pod. His brother Justin's done 2 deals. Now Liam's missus Maddie's, she's just done a single deal, pulled the equity back out. She made $90,000 equity gain in 4 months, and now she's about to roll into 2 deals.
So think about that. Lukey was $250K down.
Yeah, imagine he
if
did nothing.
You counted all of the people that have done their deals, that net result, just from him making that one decision to reach out.
Well done, Lukey.
Isn't that incredible?
Well
the power of that is just so awesome. Yeah. I love that.
But that's why it's so impressive to me, because it's resilience. You know what I mean? And it's just his nature. You listen to the pod. He's a very upbeat guy. Like he's a very positive person, and he's just like, all right, it sucked. I lost that much. How do I do it properly now? I did it incorrectly. How do I now do it correctly? And so that's what I love. The change in that was so awesome to witness and obviously to be a part of as well. So, and you're right. Then he's built the whole circle around him, or like, they're all in their 20s, and now, but cumulatively, they're like 12 or 13 properties. It's crazy.
That's insane.
It's amazing, man. I love it.
And it doesn't matter what age you are, right? He was in his 20s. We got clients coming on in their 40s, 50s.
Yeah.
It's never too late.
Never too late.
He's trying to think of a funny line there.
No,
he's trying to catch
no.
Okay.
Well, when is it too late? When is it too late? Came out last week. That's what she was thinking about.
Yes. Okay. So that was awesome.
Beautiful.
What do you think, guys? How did you think that wrap went?
Really good. I think everything we went through gave the listeners a bit of gold. Beautiful.
All right. Sounds good. All wrapped. Done.
Nah, I think I've got a butt in here. I've dusted off the archives. I've found a bit of gold for the listeners. So
is this another end of financial year recap?
You got some more stats?
It is not. So I think we're going to put a clip up.
Are you saying to all the listeners,
yes,
because we film these, that there might be a day when you do the worm as part of the podcast, so we'll actually record that?
Man, I'm going to ask.
No, the deflection.
No, it's not a deflection at all. I'm going to ask the producer here, Tommy. Mate, what's a big number that we're aiming for? I have no idea about podcasts or anything here, mate. I just get on and have a yarn with you. What's a big number we should be aiming for, mate?
I'll tell you what. We make it to 500. Let's make it 500.
That seems pretty
500 downloads or views?
No, 500
subscribers.
Oh, subscribers.
We're already at that, aren't we?
Oh, don't get ahead of yourself.
1,000. We'll call it 1,000.
Yeah, go the clean 1,000.
Clean grand.
Yes.
All right, clean grand. All right, if we hit 1,000, I'll start a net with a worm.
Here we go. There would be the worm.
Here we go.
That's true.
I feel like the listeners deserve it.
Here we go. The cameraman's getting ready. What are we at?
I think it's a classic stitch up. Sammy, we've got well and truly over 1,000 subscribers. The worm is coming today.
The worm's out. What are we at?
1,400 subscribers.
Hey!
We're well
Here
over.
it comes. Yes, Jordan. Yeah, good.
Classic stitch up.
Oh, no. It's pandemonium here.
1,400.
Wow, that was good. That was good air. I haven't done that for a while. The worm king of the Gold Coast is here.
You did it forward too. Most people can only do it backwards.
Bruh, you look like a massive slug just slothing its way across the carpet.
You are a slug. I'm actually... So you got a slug.
Oh, well done. So the worm, if you're listening in your car, do not crash. You're gonna have to
the
go.
worm was dropped. Worm was
You're
dropped.
going to have to go to YouTube and check out Sammy's worm. It's right at the end of the app.
Yeah, where are we? We're 111. That's
111.
not there we go.
I've looked
111.
after the listeners today. You've got gold in the episode, but Sammy doing the worm has to take the
I
cake.
think that's your best stat for today. Lukey. Well done.
Absolutely.
1400. Well done, team. Well done.
Well done,
Morgs.
guys. That's an amazing
Lukey,
stat.
well done, son.
That's a
Jimmy,
great stat.
do a
Well
fist
done.
air pump. I was throwing
Well
my pen
done.
at ya. Mate, well done. So now the new target, always, guys, the goal's been hit. The new target's
What
at
do you
10,000.
think?
Well, it's at 10,000 for the windmill. Send it on, guys,
10,000 subscribers.
for the windmill.
Okay.
I'll hit the windmill
if
on
you- What does the wind?
No.
Has Morgan seen the wind?
I don't know.
No, that's a helicopter.
Okay.
That's a meat spin, isn't it?
All right. So we've gone down a whole different road here, folks.
Wait, what holes are you going down, son? Keep your mouth clean. Listeners, thank
Wrap
you
it up,
very
wrap
much for tuning in. Lukey, thank you very much. Morgs, thank you very much. Listeners, thank you very much for tuning in once again to the Scouting Australia podcast. I hope you enjoyed the end of financial year recap. Those of you watching at home, I hope you enjoyed the worm. I can feel my knees. I can feel my slug. I think the rest of it's gone in the ground somewhere. But anyway, guys, I hope you enjoyed it. It was a great app. If you took great value out of it, as always, if you haven't left us a 5-star review yet, please jump on there, leave the review. It helps us build up through the charts and gets us out to more and more people, which is obviously spreading the love, spreading the influence. So guys, also, if you took great value out of it, please send on to anyone. Any stats you think that are super relevant, or anything you heard in this that you think, one of your, someone that you might know might take some great value out of this, please send it on. As we discussed a couple of times in this, obviously the circle of influence and building those people around you to think on the same level and start operating at that level and start having those higher level conversations. I guarantee you nothing will move the needle further in your life and in your property investment journey than if you build some people around you can start having those higher level conversations. So please, guys, keep sending it around, keep sharing it around. We'll be back next week for another app live in the studio. Guys, thank you very much for coming in once again. And until next week, guys, have a great one.